Welcome back to Trading with CJ. Now, this is going to be a fairly brief one today. I recently made a video on what stocks are, where I spoke about what a stock is, what the market is, and briefly spoke about ETFs. If you want to check that out, I'll leave that in a link in the description below. This video is going to be more specific to just ETFs and go into a little bit more detail on them. I'm going to keep this really simple for anybody who's just starting out or who wants to learn a little bit more about what ETFs are. Now, if you find anything in this video useful or interesting, please hit the like and subscribe button. It really does help out my channel. So, let's get into it. So what are ETFs? Well, ETF stands for Exchange Traded Fund. And what it is basically a group of companies or individual stocks that are put together into this one ETF which you can invest into. So let's take the FTSE 100 for example. The FTSE 100 is the top 100 companies in the UK. Now if you wanted to invest into the top 100 companies without buying an ETF, you would have to buy each one of those individually, which could be a time consuming process. The ETF takes all the hassle out of that for you. Now it's also worth mentioning that just because this particular fund is the FTSE 100, it doesn't mean it's split 1% into each company. You'd have to find out online exactly how it's split. You can see here, this is the FTSE 100 for example. It's 4% in some, 3% in some, 5% in some. And that's the same for every ETF. It's not necessarily split evenly. So it's worth finding out that online. Just type in the name of the ETF and it will give you a breakdown of how it's split. The last thing on this is there's not just one ETF for the FTSE 100. There are loads, just like every other ETF out there. It's really up to you what company you want to go with. So for example, you've got the Vanguard FTSE 100, the iShares FTSE 100, or the HSBC FTSE 100. It's still the same fund, but it's just different prices and different companies managing it. So what are different types of ETFs? Well, I've obviously already spoke about the FTSE 100, which is the top 100 in the UK. You've got the FTSE 250, which is the top 250 companies in the UK. Probably the most popular stock ETF is the S&P 500, which is the top 500 companies in America. So these are all tracking particular stocks. There is not only just stock ETFs. You can have an ETF that tracks real estate, such as the UK Property ETF, which is tracking the price of UK property. So if property prices are going up, your ETF is also going up. You can also get ETFs which track commodities, such as gold. So if the price of gold is going up, then your ETF in gold is going up. It's just a lot easier and a much cheaper way of diversifying your portfolio. So let's take a look here at the gold ETF. This is physical gold, the iShares one. Currently about £25-26 per unit of gold. If you was to buy a physical gold bar, that would cost you God knows how much, hundreds and hundreds of thousands of pounds, or even necklaces, etc. It's expensive. So if you don't have that money to put away on gold, but you still think the price of gold is a great investment, you can invest in an ETF of gold, which is tracking the same thing. So how do we buy ETFs? Well, it really is simple. The exact same way that you would buy a stock. So you need an investment platform or a brokerage of some sort. You can just download these trading apps and then you can go in and buy an ETF. Now I'm going to give you an example of a purchase here. I'm not a financial advisor, so this is purely an example purchase. You should always do your own research when investing into the stock market. So I'm going to go ahead and buy one unit of the FTSE 100. So I'll just type in FTSE 100. I pick the particular fund that I like. I can buy one and there we go. So that cost me £28 for one unit of the FTSE 100. And I now own a very small amount of the top 100 companies in the UK. Now ETFs have to be managed by somebody, whether that's a very passive management or more hands-on. Therefore there's always a small cost or a small fee. The FTSE 100 for example, you have to pay, I think it's 0.5% roughly per year. So there's nothing to worry about. Some of these ETFs can be a lot more than that. Not massively more, but a little bit higher. So you can do your research online into the exact costs and fees that you'll have to pay. But it's also worth mentioning a lot of ETFs pay dividends. So the dividends automatically counteract the fees and give you more as well that you can reinvest. FTSE 100 between 1.5%, I think, or 2.5%, something like that per year. So that's nice of them as well. Dividends, and it's another reason that a lot of people invest into ETFs. If we're comparing ETFs with savings accounts, I won't go into too much about this, I'll go into another video on that, but savings accounts are roughly paying you at the moment about 0.5% per year if you're lucky, to be honest. And if we look at, on average, the S&P 500, which is the top 500 companies in America, if you was to invest into that ETF, on average it grows about 8% per year. So even if it has a bad year, it's still going to be doing massively more than what your savings account is. But we can cover that in another video. Now, ETFs are considered safer investment options. But as with all investing, there is always an element of risk. But by investing into ETFs, you are lowering that risk substantially. You'll be a lot more diverse with your portfolio. And history has shown that over time, the markets will continue to rise. And as ETFs are generally tracking specific markets, they will generally rise as well, which is why they are considered a safer investment option. So I hope you found this useful or interesting, and if you have, please hit the like and subscribe button. Also, let me know below what ETFs you're investing into. On this channel, I've also got an Investing for Beginners series. I'm constantly adding to it, so check that out. I'll leave some links in the description below. So thanks for watching, and until next time,